Hello everyone, welcome or welcome back to my channel. You're watching Swathi's Commerce Tutorials. I'm Swathi and I make educational content related videos in my channel where currently I'm making a series of accountancy made easy and interesting. Four parts of the videos have already been covered, and these videos are especially for those freshers who have just entered the commerce field and want to make their base strong, especially in this accountancy subject. All the links of the previous video I have left in the description box below, as well as I'll leave the link of the playlist in the I button up there. Please do go and watch it now. Without any further ado, let us quickly start today's session, that is Accountancy Made Easy and Interesting Part 5. Here we are going to see the theory base of accounting. Since this is a part 2 of accounting video, we have already covered GAAP as well as half of the accounting concept. The rest of the accounting concepts and accounting conventions are going to be covered in this session. That is objective evidence concept. This is the first concept of today's class. Well, what does this objective evidence concept say? Let me tell you. This concept says that whenever any accounting transaction is supposed to be recorded in the books of account, it should be free from bias of the person who is supposed to record those transactions. That is, one particular document should be acting as an evidence in order for you to record those transactions. If any purchase has been occurred in the company, if you have sold any goods to an XYZ party, then the purchase invoice, the sales invoice, or the vouchers, the bills, the certificates, or any challans that support the transaction of happening on that particular date should be there. Otherwise, you cannot record those transactions in the books of accounts. The next concept is accrual concept. Accrual concept talks about two things. One is revenue and the other one is expense. It says that the revenue are recognized when they are earned but not when the cash is received, and expenses are recognized as they are incurred but not when the cash is paid. Let me give this example that there is a company and it is a service based company. It lends out project and it bills for this project only at the completion of the project. But there are employees in the organization who are supposed to receive their wages on 20th of every month. Now the project is supposed to be completed on 30th of the month, and 20th of the month you are supposed to pay the wages, and you can show that expense in your books of account because they are incurred before they are going to be paid. Next is realization concept. Realization concept is a half portion of the accrual concept where they say the revenue is recognized when it is realized, and we will not wait for the particular time as and when that cash is received. Hence, the profit is earned, that will be recorded when it is actually earned and will not wait until the cash is getting credited to the books of accounts. Next concept is matching concept or the matching principle. This says that the revenue and expenses of any transaction should be included in the same accounting period. That helps them easy for recording these revenue as well as expenses. Why? Because first the revenues are recognized and they are entered in the books of accounts, and the same cost that have been incurred for realizing those revenue will be recorded in the books of account, and then we can match our actual revenue. For example, the revenue realized was 10,000 and the cost that has been incurred to recognize those revenue was 6,000. Then how much will be our actual revenue? It will be only 4,000. That is why matching concept helps us to match our revenue with our expenses, and it gives a clear picture of how much we have earned in that accounting period. Next concept is legal aspect concept. Legal aspect concept means that all the accounting records and the books of accounts should be maintained as per the legal requirements of the company. Let me give an example. If you have sold any goods to an XYZ party and without his approval you have showed him as the debtor of the company, then it will not suffice. The approval of that party should be necessary to show him as the debtor only when that has been a credit sales made in your books of accounts. Not only that, all the accounting records should be kept and the statements should be maintained or prepared in the manner that is prescribed by the law or any other act that is relevant in that matter. The next concept is a full disclosure concept. This concept says that all the relevant information that are necessarily to be shared to the general public must be shared without any hesitation. That is, what is the type of inventory valuation you follow, what is the depreciation technique you follow, how much profit you have earned in that accounting period, and how much loss you have made in that accounting period. All those information should be shared to the general public without any discrepancies. Well, these were all the accounting concepts, and let us quickly start our next topic, that is accounting conventions. There are four types of accounting conventions, and the first accounting convention is convention of consistency. Here we say consistency is the key. That is, the business shall follow the same accounting principles, practices, methods that they have followed from the time of their establishment. That is, we say that a company has been established with a motive of running for a long period of time, and throughout their tenure, whenever they are going to value any asset, whenever they are going for an evaluation of the assets or liabilities, the same techniques and practices or the methods of valuation should be followed, which they have followed in all the preceding previous years. This will be helpful for the general public to give a clear picture of the company, and the transparency of the company's records shall also be maintained in their books of accounts. The next convention is convention of conservatism. This says that the company should always be ready for any worst possible scenarios that is going to be occurred in that company. That is, you will have to imagine that if at all any further losses, if at all the company crashes down, or if at all the company shut down, it should have a backup plan for all these losses or for all these worst case scenarios. You have to maintain provisions, you have to maintain bad debts, you also have to maintain the certain revenues that should be required for you to pay out all these liabilities if at all your company is going to face any such circumstances. Next convention is convention of materiality concept. This materiality concept says that whatever information, I said that in the concept of full disclosure, we are disclosing all the information that are relevant to the general public, but while disclosing this information, only the material facts should be shared. You cannot just blabber that we have made 1 crore of profit, we have made 10 crore of profit. You cannot say that. It should be material enough and it should be believable enough, only then that convention will surface. The last convention is convention of full disclosure. This is same as we have mentioned in that full disclosure concept, where all the information which are relevant to the general public should be shared without any discrepancies. Only then you can maintain all the books of accounts in an easy manner, and also the general public who are viewing your books of accounts, it will be easier for them to get a clear picture of this books of accounts of the company, and then they will be helpful for them to decide whether they can invest in this particular company or whether to skip this company. That's all for today's class, my dear students. Thanks for watching. If you like my videos, please do like, share and subscribe to my channel. We'll meet you in the next class. Thank you.